Let's bring in Satori Fund founder and portfolio manager Dan Niles, who joins us in a Closing Bell exclusive. Dan, always good to see you. Thanks for joining us. In fact, before we get to the picks for next year, kudos on the picks for this past year, in particular the XLE energy stocks, Oracle and JP Morgan up 30 to 50% respectively. And what I think is interesting, just quickly looking back on last year, is those best performers aren't what we typically think of Dan Niles, tech investor. They're sort of value type plays that have performed well of your picks.
Yes, I mean, I think with valuations where they are, I mean, I'm a growth at a reasonable price type of investor at heart. So I'm not a momentum investor by nature. And I think with market valuations up at these levels, we've talked about it before, market cap to GDP up at 1.9 times, a 50-year average of 0.8, tech bubble peak of 1.4. I think you have to get more defensive as the market goes up, especially if you are finally in an environment where you have high inflation and a very aggressive Fed probably coming up. That's a much different backdrop than what you've seen for 13 years since the global financial crisis.
And as we get into the picks for next year, two key areas carry through from last year, and that is energy and banks, though you're changing the specific picks. Talk us through the reasons behind that and what those picks are.
Sure. If you look at oil prices last year, they were up 58%. Or sorry, this year, which we're finishing up. The year before, they were actually down 21%. But oil demand, was at about 99.6 million barrels per day back in 2019. We're about 3 million or so barrels below that. And I think what you'll see is as we sort of adjust to the fact that COVID's going to be with us forever, become endemic, and everybody kind of goes back to living life by the end of next year, I think you're going to see oil demand actually surpass the levels that it was in 2019. At the same time, you've got environmental concerns restricting the supply. You're not handing out big drilling permits. And this is across the globe, not just in the U.S. to some degree. So I think you're going to see oil prices head up into the 80s, 90s next year when you put those two things together. When you look at banks, it's sort of a similar situation where you've got 10-year treasuries sort of at that 1.6% level or so, 1.55 or so. And I think you're going to see that go well over 2%. Probably in the first half of next year as the Fed stops buying treasuries and starts raising rates. At the same time, with the easy money gone, people are going to have to go to banks to get loans. And you're not going to get it from the Fed or from the government. You're going to go to a traditional bank. So I think you'll see loan growth pick up. So that's why we like for this next year at the USO and the KRE for energy and banks respectively.